Welcome to Looking at the Markets with David Moadel. I'm very privileged to have a special guest today. His name is Mr. Michael Pento of Pento Portfolio Strategies, pentoport.com. And he is, in my estimation, one of the premier finance, market, and commodities experts out there, and my audience will very luckily, get to tap into his expertise and insight today. Let me welcome Mr. Michael Pento. Thank you for joining us today.
Thank you so much for inviting me on the program, David.
Yeah, absolutely. Just a little bit of background. Mr. Michael Pento is the president and founder of Pento Portfolio Strategies. He's got a weekly podcast. Make sure I get the name right. The Midweek Reality Check. Is that the correct title?
That is correct.
Yeah, and that's what we need badly is a reality check in this market. And
minutes, but it never really is. It usually runs 10 to 15, but you get your money's worth in that program for sure.
Absolutely. And author of the book, The Coming Bond Market Collapse. That's a title that cannot be missed, and a book that cannot be missed. So speaking of market collapses, I mean, I'm not going to ask you to be a top caller, but because that is usually not a winning game, I've found. But with this bull market getting a little long in the tooth, perhaps some people might say. We've got the S&Ps hovering at or near all-time highs since Brexit, which was June, July of last year. We haven't had what I believe to be a meaningful pullback since then, unless you want to count the 5% overnight dip on election night, which came right back up that same day.
Wait o'clock in the morning to take advantage of that particular
short window of opportunity there. So without necessarily top calling, are we nearing a swan song for the markets?
Well, here's what we do know. If you look at various metrics such as the CAPE ratio, the cyclically adjusted PE ratio of the S&P 500 earnings going back 10 years, if you look at the market price to sales, if you look at median PE ratios, if you look at the total market cap to GDP ratio, these metrics are off the charts. So what we do know for sure is that when these metrics are virtually at all-time highs in conjunction together, then we know that going out 10 years from now, that the returns on equities will be extremely low, very, very low single digits, and they usually incorporate in that time frame about a 50% haircut in equity values. So when you talk about timing the market, and that's something I do try to provide my clients, what I'm looking at to divine that particular moment, and there is only one God and it's certainly not me, but what I do look at is for a flattening of the yield curve, the flattening of the spread between the 10-year note and the 2-year note. And when that happens, usually shortly thereafter, you will see a plummeting of break-even spreads, inflation break-even spreads. And when those two things occur in conjunction, usually you can bet that the market, especially given the macroeconomic environment that we've engendered, that the market will have a significant, and I talk about significant meaning at least 20%, more likely 50% pullback in stocks.
50%, bold prediction, but that's why we have you on here. I like that.
I didn't say it's going to happen tomorrow.
Right.
I did say we're going to have very, very, historically speaking, we're going to have very low returns over the next 10 years. And when you see, and this is why people move their money to Pento Portfolio Strategies, because this is what I do every day. I'm looking at those break-even spreads. I'm looking at the spread between long-term interest rates and short-term rates. And I'm trying to time when to short the market. You can go broke just always being long gold stocks and always being short the market. You have to know when to slide along that inflation-deflation spectrum, and that's what I specialize in doing.
Right, absolutely. Speaking about what you specialize in doing, I just wanted to touch upon Pento Portfolio Strategies. I've got www.pentoport.com. I will put the link in the description for sure. When people visit that website, what will they see and what services do you offer?
Well, they'll see a scrolling pictures of me in the media. I've been thrown out of most financial media as far as television is concerned. Going back to rolling your eyes at Erin Burnett is really not a really great career move. But what I was trying to explain when I was on the financial media is that interest rates don't drop to 0% and stay there forever. That's basically what I was trying to convey to Erin Burnett. And I guess the Keynesians that dominate the financial media don't like to have someone who backs up their strong opinions with facts, which is what I always try to do. So I'm firmly in the belief that we're headed for a bond market collapse worldwide. I wrote a book about it in 2014. And I predicted that back in 2014 that in the end of 2016, we would start to see the bond market unravel on a global basis. Certainly, we've seen the 10-year note yield go from 1.3% in July of last year to where it is today, about 2.5%. And I think what's going to happen later in 2017, if you look for catalysts for those events that I just described, the flattening of the yield curve and for break-even spreads to contract. If you look for a catalyst, I look over at the ECB, the European Central Bank, and from the Bank of Japan, BOJ. If you see a change in either one of those monetary policies, you should see a spike up in yields that will go from where they are today. The 10-year note yield in both those countries was just about 0% in Japan and about 0.4% on the German Bund. If they start to taper, Mario Draghi tapers in Europe or Mr. Kuroda tapers in Japan, you should see a violent spike up in yields from where they are today, closer to their inflation target of 2%. And when that happens, it's going to send chaos across the world in currencies and in equities and by definition bonds, and even will pervade across global economies. That's the catalyst for the yield curve to completely flatten out, which I think, by the way, it's in the process of doing anyway. That will expedite and exacerbate that move, quicken that move, and that is when you probably want to just run away from the stock market, which, as I just described, by various metrics, is just about the most overvalued in history outside of the year 2000. So be very, very cautious and be very, very attentive.
Absolutely, that's huge. That's key. But being cautious or running away from the stock market, what does that mean? Does that mean going into silver, gold? What do we do?
Well, when do you want to own gold? And this is part of my model. So when do you want to own precious metals? You want to own precious metals when the dollar is going to fall and real interest rates are going to fall. So right now the portfolio is slightly underweight gold because what's happening? Nominal rates are rising. And I'm a firm believer, unlike most people I run into today in the financial media, I'm a firm believer that real interest rates will rise in the short term. So nominal rates are rising, and I don't believe we're going to have a bout of intractable inflation at this juncture. It's going to take a change of monetary policy on the part of the Federal Reserve. And that's when I think you're going to see the dollar weaken. I think later this year when we run into one of those catalysts that I just mentioned, you're going to see the yield curve flatten, break-even spreads collapse, and that will cause a change in monetary policy on the part of the Federal Reserve, from a tightening policy to a easing policy, and then eventually, if you're asking me where we're eventually headed in a longer term, I think we're going to deploy helicopter money, because when the stock market drops again, it will drop 50%. It usually drops 50% during 35 to 50% during normal recessions. I can assure you that this will not be a normal recession. We don't have the bullets to fight. For example, the Great Recession, the Federal Reserve took interest rates from 5.25% on the Fed funds rate to 0.
Yeah.
Well, the next time the yield curve flattens, it'll probably flatten at around a 1.5% to 2% Fed funds rate. We just don't have 525 basis points to reduce interest rates. Plus, we have 20 trillion in debt instead of 10 trillion in debt like we had in 2007, to 20 trillion national debt. So there's not going to be any huge TARP program either. So we're going to have a very bad recession that's going to be met, in my opinion, by something known as helicopter money, which is the direct monetization, not using any kind of primary dealers, any kind of private banks, a direct monetization of debt. So the Fed will find a way to send money to individuals directly. They'll either be buying stocks or directly buying bonds from the Treasury. So at that juncture, you're going to see gold spike like it's never spiked before. It's a coiled spring right now because of the nominal level of interest rates that have been. By the way, I find it very funny that we have the Fed funds rate at 1% or below for 100 months, David.
Yeah.
Your audience has to understand that we had a 1% Fed funds rate between 2003 and 2004, which is 12 months according to my calculation, and that engendered the entire housing bubble, which almost brought down the entire global financial system. We have 100 months, not 12, 100 months of 1% or less.
Yeah.
And that has blown up equity prices across the globe. Bonds are in a huge bubble. Real estate is at an all-time high. I'm seeing home flipping shows now on television. So, when this bubble breaks, and it will, as all bubbles do, that is when the chaos really begins.
Yeah. Wow. Scary but important information that we all need here. Somebody's got to say it, and it sounds like you're doing it, whether it's on CNBC or on here. We appreciate it.
Not going to throw me off. See, there's a whole bunch of websites such as yours that have real news, that give people like me a forum to speak their mind and give real facts.
Right.
Right now, there's one thing Donald Trump did expose is the plethora of fake news that abounds out there, where people just want to hear what they think they want to hear as far as Keynesian mantras, that the economy was bailed out from a debt problem and a housing bubble problem and artificial interest rate problem by vastly and exponentially exacerbating all three of those conditions.
Wow. Let me ask you this. I'm personally thinking about getting into commodities or precious metals. Do you trust ETFs such as SLV, GLD, or should I get the physical stuff? What do you think?
Well, you certainly, first of all, I always recommend you should have about 10 to 15% of your net worth in physical gold. And when I say physical gold, I mean that gold that you can have in your own possession, not necessarily in your home, but something you can access that's outside of the counterparty risk. So we'll start there. Then from there, you should have precious metal mining shares when the timing is appropriate, because then you have that leverage of having the gold that they have in the ground. Also, there is a company that actually monetizes gold. Gold is real and honest money, and it's been so for thousands and thousands of years. But the problem with gold is if you want to go to the drugstore or a restaurant, or you want to go through the drive-up window at McDonald's, you don't want to have a bag of gold coins carrying around. It's very hard to have gold being an efficient currency. But there is a company called Gold Money. The symbol is XAUMF. I own, in full disclosure, I do own that for the portfolio and in my personal account. That is a company that actually monetizes gold. It will allow you to monetize gold using digital currency, using a blockchain technology that will allow you to use your gold that's stored physically and break it up into fractions of a gram. So now we have physical gold that you hold in your own possession, gold mining shares, and I would also recommend owning this particular stock because it's a revolutionary technology that could be huge someday in the future.
I like it. Y'all heard it here. Very good. What was that ticker symbol again?
XAUMF. It's a Canadian company, Gold Money.
XAUMF. I'm
that's for
American.
If you're American audience, it's XAU in Toronto.
XAU. Okay, gotcha. For our friends for our Canadian friends, very good, sir. Wanted to talk about Pento portfolio strategies, which is you actively manage people's capital. First of all, why is active management a necessity? Why shouldn't people just go ahead and do it themselves?
Well, I'll tell you, you know what's scary is that this go around since 2008 to 2017, March 2017, where we sit today, we've seen an absolute deluge of people that just have been buying ETFs, indexed ETFs. So the SPDR,
Yep.
The Qs, the DOW, which is the Dow ETF. I believe that's correct. But anyway, the indexed ETFs have been piled into by institutions, hedge funds, robo-traders, algorithms, pension funds, mutual funds. Everybody's piling into these ETFs, which means everybody owns the same stocks, the same group of stocks. And it's an easy trade because really since 2009, March of 2009, it's been a one-way ticket to paradise. But when this ends, and it always does, and it will, you're going to have a lot of redemptions of these ETFs that's going to trade below their NAV. And then it's going to be one big circle where you're selling the ETF. They have to sell the creation units, which is individual shares, which is going to cause the ETF to fall further. It's going to be one big vicious cycle. And the reason why you can't, that should be self-explanatory, why you can't just be a passive investor. But, usually you have some hedge against that happening by owning bonds. But if I'm correct, and we're going to get helicopter money on the other side of the next recession, then you're going to have a situation like you had in the 70s, where when we broke the gold window in 71 all the way to 1980, you had no protection from being in equities. Equities went nowhere the entire decade because equities don't really like stagflation. In fact, during that time frame, equities lost 50% of their value. And of course, if you're going to have stagflation, bonds aren't really a good investment. So you have the whole entire investment world piled into equity ETFs and bond funds and bond ETFs, which neither are going to work if we enter into a period of stagflation like the 70s. So where do you hide? You have to have an active manager like me who has a powerful proprietary model that actually works.
Yeah, absolutely. I'm as guilty as anybody of of buying those ETFs, the SPDRs, the Qs, DIA, the diamonds, all those. And the question is, when is it going to collapse? Perhaps we don't know the answer. Why not just buy the ETF and then buy some puts, or maybe just do the old the old combo of stocks, buy some of the SPDRs and buy some TLT, buy some GLD. Why not just do that? What do you offer?
I thought
what do you offer that's different from that old solution?
Let's just say that's a great question. So let's just say we're back in 2009 or 10 or 11. And you want to have that structure in your portfolio. So you go 80% long the SPDRs and the Qs and the DIA. Thank you for correcting me on that. And then you take 20%, you take 10% and put it in gold mining shares and another 10% and short the market. Well, that 20% of your portfolio would be almost zero because gold mining shares lost 85% of their value between 2012 and the end of 2015. And obviously, if you shorted the market, you'd be down almost the same amount.
Yeah.
So why take that hedge? And that's what I do here. The proprietary inflation deflation portfolio, instead of which is by the way during that entire time frame is actually the model portfolio is actually up a little bit. So what I do is specialize in timing. When do you want to hedge against inflation? When do you want to hedge against a deflationary collapse of the economy? If you get your timing right, then you'll preserve that principle. See, if you have your 20% of your hedges gone, then what do you have left to hedge against that other 80%? Well, you can keep taking money out of your 80% and put it in your hedge, but who knows? It might be, that yield curve might flatten out this year and the break-even spreads might collapse this year, or it might happen 2 years from now. Who knows? I'm modeling it and watching it. And I, like I said, I think that catalyst is going to happen this year. But who has the time to actually model that and get it right. I do. That's what I specialize in. So I'm going to make sure you're hedged against an inflationary collapse of your money. And at the same time, I'm also going to be able to hedge against a deflationary collapse of equity prices. So if you have someone who times the market with a powerful, robust model, you'll do much, much better than just doing that 80-20 kind of, I hear on that, who is that commercial that comes out that I love that has that dynamic? Can you help me out? Do you know what I'm talking about?
Yeah, I know what you're talking about.
Yeah. Let's go. That's it.
Yep. Exactly. Very good, sir. Wanted to talk about the Pento's midweek reality check. What types of topics do you cover? When I would like everybody in my audience to check out the weekly podcast. What kinds of topics will you be covering?
Well, the topics are, forgive the pun, but they're topical. So I'm looking at the data that happened during the previous week, the machinations of the Federal Reserve. I'm looking at what investments in a broad perspective, where you want to be along. I'm not going to give you actual investments, ETFs or individual shares, but I'm going to tell you where you want to slide along that inflation deflation spectrum. So you get really powerful, robust analysis and actual data, not just my opinion, actual data describing why I want to be where and why we are positioned along that spectrum.
Very good. Well, everybody should check that out for sure. I know I will. And finally, if I may ask one more question,
Sure.
What could the market do for the third time in 17 years? I got to know.
Well, it's the third time. So the year 2000, the market lost about 50% of its value. In 2008, it lost 50% of its value. And I believe in 2017, later this year, we have a very good likelihood of beginning the decline down towards 50%. And I can assure you this, David, it happened many, many times in the past. Like I said, in the 70s, we lost about 45, 50% of the S&P 500 in between 71 and 74. We had that 1987, we had a 22% crash in one day, and through the month of October, we lost about 40%, and then you could fast forward through flash crashes. The market appears to be right now like it's impervious to anything. It can never go down. And I've been licensed since 1996 and managing money successfully since then. I will tell you that it's impossible that you will never have volatility spike and the market to fall. If you look at the VIX, the volatility index, that is at record lows, and precisely because we've had record amounts of quantitative easing and central bank puts around the world. We are being told now that is coming to an end. And when that comes to an end, the global debt is at 300% of GDP. $230 trillion of global debt, a massive 60% spike, $60 trillion increase since 2008. When interest rates start to normalize on that debt, that will check to the fore, and it's then where you will have to be either short the market and or long precious metals in a big way.
Yeah. And the time to start thinking about that is now, not when it happens, of course.
Absolutely. You're absolutely correct, David.
Yep. Wow. So, you mean the VIX won't stay in the 11s forever?
No, it's not, and it's not going to the single digits either. Not forever, that's for sure, David.
Gotcha. All right. Wow. You've given us so much, given me and my audience so much to think about today, and the time to take action is now. So once again, if people wanted to contact you and learn more about Pento portfolio strategies, or just ask you a question maybe, or make a comment, is the best way to reach you through the website pentoport.com or what other way?
Your audience, especially your audience, why don't you just email me directly at mpento@pentoport.com.
There you go. mpento at pentoport.com. Great way to reach Mr. Pento, who is very accessible and has been so nice and generous with his time with me today. Michael Pento, Pento Portfolio Strategies, pentoport.com. I will slap that up on the in the description of the video, as well as your email address with your permission, of course. Thank you so much for all of your time and insight today. I'm looking forward to uploading this real soon and getting it out there ASAP. So thank you once again.
Thank you so much for having me on your program, David.
All right.